The core question that haunts every serious investor is whether market timing is a verifiable mathematical blueprint or merely a seductive myth. While conventional analysis focuses heavily on price action, support, and resistance levels, William Gann proposed a radical, counterintuitive alternative. He posited that the market moves in measurable, repeatable cycles based fundamentally on time, asserting that time is the dominant factor that controls price movement. This framework shifts the focus entirely, moving beyond typical price structures to concentrate purely on the calendar date of the future turning point. Gann's vision suggests that precise dates can be forecast months or even years in advance, independent of current market sentiment or news flow. If this premise holds true, it implies a predictable order underlying the apparent chaos of financial markets. We must, therefore, examine the specific mechanisms Gann detailed for identifying these temporal turning points. This exploration will dissect the foundational cycles and geometric laws he claimed were essential for unlocking the market's hidden clock. Gann structured his entire temporal theory upon the concept of the circle, recognizing the 360-degree framework as the universal basis for all time measurement in markets. He viewed time itself as cyclical, constantly repeating rotations that dictate market behavior. This 360-degree cycle could represent days, weeks, months, or years, depending on the scale of the market movement being analyzed. Within this circle, key degrees were identified as critical time units for expected reversals. The quarter cycle, 90 degrees, the half cycle, 180 degrees, and the full cycle, 360 degrees, are the most fundamental time markers. A market that has moved 90 units of time from a major low or high is reaching a critical inflection point. The completion of a full 360-degree rotation from a major historical high or low often signals the end of a long-term trend or the initiation of a powerful new one. Recognizing the exact starting point of this rotation is the initial crucial step in applying this method effectively. The master cycle, according to Gann, is the 60-year cycle, which he considered the longest and most powerful cycle governing economic and market history. This cycle is derived from the fact that 60 is the lowest common multiple of the first three perfect numbers, 1, 2, 3, and is a number deeply rooted in ancient timekeeping systems. Forecasting major generational highs and lows is often based on identifying these 60-year anniversaries from previous catastrophic market events. The power of this cycle is said to override shorter cycles when they converge. Below the master cycle, the 20-year cycle plays a significant role in intermediate-term forecasting. This intermediate cycle is often associated with the repetition of financial panics and major economic shifts, reflecting the lifespan of a typical business generation. Major bottoms or tops tend to cluster around these 20-year intervals, offering traders a medium-term framework for planning strategic entries and exits. While less powerful than the 60-year cycle, the 20-year cycle provides a reliable rhythm for understanding multi-decade trends. The shortest of these major intermediate cycles is the 7-year cycle, often referred to as the Heptagonal law. Gann emphasized the recurring importance of the 7th year from a previous major turning point, whether it was a high or a low. This cycle aligns with various natural and economic phenomena, suggesting a regular pulse in human activity and market psychology. These three cycles, 60, 20, and 7 years, form the backbone of Gann's long-term temporal analysis, providing a roadmap for anticipating significant shifts far into the future. Understanding these foundational cycles requires delving deep into the original teachings of William Gann himself. If you are serious about mastering the principles of market timing, you need to study his seminal work, Truth of the Stock Tape. This classic text explores the psychological underpinnings of speculation and details the market cycles that govern price movement, offering invaluable insight directly from the master. Gann's narrative provides a crucial historical context for the methods we are discussing, laying out the rules that guided his own legendary career. However, a word of caution is necessary for those seeking practical application immediately. While the wisdom and textual analysis within Truth of the Stock Tape are unparalleled, the quality of the original historical charts included in the book is often very poor. The old print methods make the original graphs difficult, sometimes impossible to read and replicate accurately today. Despite this limitation concerning the visual aids, the written explanation of market psychology and the core time cycles remains essential reading for any serious student of financial history. To start your journey with Gann's authentic voice and understand the foundational philosophy behind these time secrets, check the link in the description for Truth of the Stock Tape. Today, the most distinctive and crucial aspect of Gann's methodology is the principle of squaring time and price. This concept holds that the market achieves a state of perfect balance and thus signals a high probability turning point when the time elapsed equals the price units moved. For instance, if a stock bottoms at $100 and exactly 100 trading days later the price hits $150, the time factor, 100 days, has been squared against the starting price, 100 units. Identifying these moments of perfect equilibrium is central to forecasting reversals. Gann defined squaring as the point where the number of time units elapsed, whether measured in days, weeks, or months, precisely equals the number of price units moved from a significant high or low. When a market moves 180 days from a low and the price has advanced 180 points, the market is said to have achieved a one-by-one balance. This balance point represents a moment of maximum tension, often preceding a sharp change in direction. Traders using this method must meticulously track both the calendar and the price scale to anticipate these critical intersections. Geometric angles are an indispensable tool for visualizing the relationship between time and price. The one-by-one angle, drawn at a 45-degree line, represents perfect balance where 1 unit of time advances the price by exactly 1 unit. This angle is considered the primary line of support and resistance. As long as the market holds above the one-by-one line, it is considered bullish, maintaining perfect symmetry. If the market breaks below the one-by-one angle, it signals a fundamental shift in the velocity and balance of the trend. Gann also used steeper and flatter angles to measure the velocity of the market over time and project future time-based support or resistance. The 2-by-1 angle means the price is advancing 2 units for every 1 unit of time, indicating a very strong, aggressive trend. Conversely, the 1-by-2 angle means the price is advancing only 1 unit for every 2 units of time, signaling a weak, struggling trend. These angles are not merely price lines. They are projections of time that show when the current rate of movement will intersect a future calendar date, signaling a potential reversal. The practical application of these mechanics relies heavily on the importance of specific time counts, measured from the absolute high or low. Gann utilized a specific set of numbers derived from astronomical and geometric constants, counting forward in these units. Key time counts include 90, 144, 180, 216, and 360 units of time. These counts are not arbitrary. They correspond to geometric divisions of the circle and the cube. The number 144 holds particular significance in Gann's time counts, representing 12 squared, a number often cited in ancient mathematics and cosmology. When 144 units of time, days or weeks, have elapsed from a major turning point, the probability of a reversal is extremely high. Traders meticulously monitor the market as it approaches these critical calendar dates, anticipating that the passage of time itself will force a change in the direction of the trend. These time counts reinforce the idea that the market operates on a fixed mathematical schedule. Furthermore, Gann emphasized the concept of halfway points and thirds within these time counts. For example, 72 days, half of 144, or 45 days, half of 90, are also considered minor but significant turning points. The entire process requires the meticulous recording of market data, starting from the most significant historical highs and lows, and projecting these geometric counts forward onto the calendar. Without accurate starting points and rigorous adherence to the counting sequence, the entire forecasting model breaks down completely. The squaring process often involves looking for multiple time counts converging on the same date. A date that marks the 90-day count from one low, the 180-day count from a prior high, and the 360-degree rotation of a price level is exponentially more significant. This synthesis of temporal factors is what separates a simple cycle identification from a high-probability forecast. The market reversal is often not caused by a single cycle, but by the simultaneous expiration of several time constraints. Beyond the geometric and long-term cycles, Gann identified specific, annually recurring time windows that significantly influence market reversals. The rule of anniversaries dictates that markets respect the specific calendar date of prior major highs and lows with remarkable consistency. A market often experiences turbulence or a sharp reversal precisely on the 1-year, 2-year, 5-year, or 10-year anniversary of a prior major turning point. This phenomenon suggests a collective market memory tied to the calendar date. These anniversaries act as temporal magnets, drawing the market back toward the energy exerted by the original turning point. If a stock made a major low on October 15, 2020, then October 15th of 2021, 2022, and 2025 become high-probability reversal dates. Traders must mark these dates on their calendars, regardless of the current price action, as the time factor alone can initiate a change in trend. The closer the price is to a significant level on the anniversary date, the more powerful the expected reversal. A crucial component of seasonal timing involves the cardinal and fixed crosses, which align with the 4 critical time points in the year. These points correspond to the equinoxes, around March 21st and September 21st, and the solstices, around June 21st and December 21st. These dates mark the completion of the 4 quarters of the year and are associated with powerful natural and celestial shifts that Gann believed influenced human psychology and market behavior. The market often forms reversal zones around these quarterly points, as they represent the 90, 180, 270, and 360-degree divisions of the annual cycle. The period immediately preceding and following these cardinal dates is considered highly volatile and ripe for trend changes. By calculating the elapsed time percentage of the total year, traders can anticipate when the market is reaching a temporal limit based on the annual cycle. This system provides 4 guaranteed recurring time windows every year. Gann also utilized the fixed crosses, represented by the midpoints between the cardinal crosses, approximately February, May, August, November, and November. These fixed dates often mark secondary, intermediate reversals within the larger quarterly trend. Together, the cardinal and fixed crosses provide 8 specific time windows throughout the year where market energy is expected to culminate and shift. Mastering this annual rhythm allows for systematic planning regardless of the prevailing economic narrative. Another powerful seasonal rule is the halfway point rule, which emphasizes the significance of the exact midpoint in time between 2 major turning points. If a market takes 300 days to move from a major high to a major low, the 150th day is a critical time marker. This midpoint often sees a sharp counter-trend rally or decline, acting as a crucial pivot within the larger movement. This rule applies equally to time elapsed between a low and a subsequent high. Identifying this halfway point requires precise measurement of the time interval, not just an estimation. The market is said to rest or rebalance at the exact halfway mark of the total time span covered by the preceding major move. This rule reinforces the geometric nature of time, suggesting that market movements are symmetrical not just in price but in their duration. The convergence of a halfway point with a specific time count, like 90 or 144, dramatically increases the predictive power of the forecast. The synthesis of these annual and seasonal methods provides a high-resolution temporal map for the short and intermediate term. When a 7-year cycle anniversary aligns with a cardinal cross date, the resulting predicted reversal is considered extremely potent. This layered approach ensures that the forecast is not reliant on a single isolated factor but is supported by multiple converging temporal pressures. The goal is always to find the date where the most independent time cycles expire simultaneously. The meticulous detail and mathematical consistency of William Gann's time cycle blueprint present a compelling argument against the notion of random market movement. However, the greatest challenge in applying this system today lies in the necessity of specificity, often referred to as finding the proprietary key. Gann himself frequently stated that the starting point, the exact high or low from which all subsequent cycles must be measured, was the most difficult piece of the puzzle. Without the correct key, all subsequent calculations, regardless of their mathematical precision, will be offset and useless. This complexity is compounded by the fact that Gann integrated various cycle types, including astronomical and geometric components, in a way that remains difficult for modern traders to fully reverse engineer. While the historical validation of Gann's timing success is widely documented, the reproducibility of his methods by contemporary practitioners remains a major hurdle. Many traders can identify isolated 90-day or 7-year cycles, but few master the integration required to predict a specific date with high confidence. The difficulty arises because the system requires the synthesis of long-term 60-year cycles, intermediate 7-year cycles, geometric squaring, and annual windows all converging on the same date. A failure to correctly weigh the influence of the dominant cycle at any given time can lead to a completely erroneous forecast. This is why the blueprint provides a powerful theoretical framework, but its practical application demands mastery of cycle synthesis, not just the identification of individual components. Ultimately, Gann's time cycle blueprint forces us to abandon the simplistic idea that price is the only variable that matters. It establishes that time is the true governor of market action, determining when the energy of a trend must expire. While achieving consistent, successful market timing using this method requires profound dedication, the framework itself offers a powerful lens for anticipating high-probability time windows far in advance. The challenge is not whether the cycles exist, but whether the student can achieve the precision required to unlock their secrets consistently.